So we are going to look at a question on joint operation. So in joint operation question, as you know that there are two parties. So the important thing is to look at the end of the question to see which party are they referring to. So if we go to the end of the question, you can see that they ask you to prepare journal entry in the books of North Limited. So keep that in mind when you prepare the journals, you are preparing the journals for North Limited. Then we go back to the question. As you can see that we got South Limited and then North Limited in this joint operation agreement. As you know, there are two types of journals that we need to prepare for joint operation. The first type is contribution journal. The second type is year-end allocation. But before we do that, we have to make sure that we know about the percentage of contribution that the joint operators provide. So what we need to do is to look at the information of the initial contribution and prepare a table to see about the percentage contributed by them. So you can write down any format, it's just for your own working. So for this one, we're going to write down the party. So South and North. And then on the left hand side, we are going to write down the type of assets contributed by them. So in this question, we got cash and equipment. Okay, so we're going to go back to the question. Take a look here. South Limited, it contribute cash of $1.8 million. North Limited, on the other hand, contributed 1.2 million cash and equipment with a fair value of 1.5 million. But with the equipment, it also says that it has a carry amount of $1 million. Those are the information about their initial contribution. So we wrote down that information on this page. So for South Limited, it contribute 1.8 million of cash. North Limited contributed 1.2 million of cash. So in total, they contribute 3 million cash. In terms of equipment, South Limited didn't contribute anything. North Limited, on the other hand, contributed 1.5 million in terms of fair value of equipment. You can also write it down at the bottom here. The carry amount of that equipment is $1 million, and that will be helpful in our calculation later. In total, both parties in total contribute 1.5 million worth of equipment. Finally, we're going to add up the total contribution for each party. So obviously for South Limited, because they only contribute cash, as a result, the total will also be 1.8. North, on the other hand, contribute 1.2 million cash and 1.5 million equipment. So in total, they contribute 2.7 million. So that means both parties in total contribute 4.5 million. So the purpose of this table is to look at whether they are providing equal contribution. If not, what's the percentage contributed by them? So at the end of the table, we're going to write down the percentage. So how do we calculate that? Very simply, 1.8 million divided by 4.5 million, you'll find that you will have 40%. On the other hand, for North Limited, they contributed more. After you do the calculation, you'll see that they contribute 60%. And this is a very, very important information, because now you got two parties that have different percentage of contribution. And remember, this question only require you to prepare journals for one of the party. And in particular, for this one, we want North Limited. And 60% is the information that we need. Okay, so that is the beginning of the question. After that, we can then start preparing journals based on the information that we just wrote down. So as I said, there are two different types of journals that we want to record. The first one is contribution journals. The second one is the year-end allocation. So in terms of the contribution, we got the initial contribution. So based on the question, 1st of July 2014, that's the initial contribution. And remember, we need to prepare journal for North Limited. Okay, North Limited. So going back to the table, you can see that North Limited contributed cash and also equipment. Okay, cash and equipment. So what we first need to do is to write down the credit side of the initial contribution. So we go credit equipment and also credit cash. So based on the table, and very importantly, because the credit come out from the record of North Limited, and we need to use the carry amount. So for cash, there's no difference. We're going to use 1.2. On the other hand, in terms of equipment, from North Limited record, they recorded 1 million of equipment. So for this one, we will have $1 million for equipment, and we will have $1.2 million for cash. There's one more thing we need to recall on the credit side, because you know that there's a difference in carry amount and fair value of equipment. As a result, there's a gain on sale from North Limited perspective. So we're going to write down credit gain on sale, and you know that this one is about equipment. Okay, first of all, gain on sale, you need to compare the fair value and the carry amount. So the fair value was 1.5 and the carry amount is $1 million. That means in total, they have $500,000 gain. However, you're not going to recognize the entire amount because as a joint operator, you are keeping ownership interest in the asset. And if you think about that, in this case, North Limited, they are going to contribute 60% of the asset. In other words, they are going to keep 60% of the interest in those assets, which means that they are only going to sell 40% of the interest to the other party. So when you calculate gain on sale, you have to multiply by 40%. So as a result, the gain on sale is 200,000. So that will be on the credit side. In terms of the debit side, we need to think about what do we get in return, because you contribute certain amount of asset to the joint operation, and also you will be able to share a percentage of those assets back as your own record. So on the debit side, we got cash in JO, and we also got equipment in JO. The reason that we need to use in JO, that is to distinguish that this asset has been contributed to the joint operation. Now we're going to share those assets back in our own record. Again, we're going to go back to the table. So based on here, we want to know how much cash and equipment that we have. Cash in total, we got $3 million. And that $3 million, we are going to get 60% of that amount. So we go back to our journal, we're going to write down that's $3 million multiplied by 60%. So as a result, we are going to have $1.8 million for cash in JO. In terms of equipment in JO, it's very important that you know that this journal is for North Limited. And in terms of North Limited, they contributed the equipment to the joint operation. As a result, when we calculate this amount of equipment, we also need to use the carry amount. So we're going to use $1 million, and you're going to get 60% of the interest. So for this one, we're going to get 600,000. It's very important you notice that every single amount here requires calculation. As a result, it's very important that you try to add up the debit and also add up the credit to see whether you are able to balance the journal. If you can't balance the journal, either you have missed an account or you are miscalculating one of the amount. So you can go back and check for that. So in this case, you can see that on the credit side, we got 2.4 million. On the debit side, it also got 2.4 million. So you know that you're getting it right. So that will be the journal for initial contribution. So in some of the joint operation question, after this journal, you can then go to year-end allocation. But in this particular one, there's one additional information you need to be aware of. It says that on 31st of December 2014, that means a few months after they set up the joint operation, both parties, they want to make additional cash contribution. So any contribution by the joint operator, you need a journal for that. So after the initial contribution, they decided that they want to put in more cash. But the trick here is that they didn't actually tell you how much did they put in. They didn't actually do that. So where can you actually get the information? As you can see that we have a number of tables in this question. The second table, this one is about receipt and payment. In other words, this one is like a little cash flow statement for the joint operation. So on this particular statement, you can see that on the right hand side, there's $5.5 million of contribution. What does that mean? It means that in total, both of the joint operators contributed $5.5 million cash in total to this joint operation. So this information is going to help us to work out the amount of additional contribution by each of the joint operator. So $5.5 million, this is the total that we have. Then we go back to the table that we prepared. We know that initially they contributed $3 million. Okay, now we are getting somewhere because the additional contribution on 31st of December 2014, it was a cash contribution. So the calculation is 5.5 million. And then we want to minus the 3 million contributed by them initially. So that means on December 2014, they contributed 2.5 million in total. And remember, North Limited, they have 60% of ownership interest in this joint operation. As a result, they are also going to contribute 60% of their cash in this additional contribution. Okay, so that's the calculation. So that's equals to 1.5 million. So we're going to prepare journal for that. So we're going to debit cash in JO. And we're going to credit cash. So that will be all the contribution journal. So after that, the second thing we need to do is the year-end allocation. Again, we go back to the original question. Think about that. So we got 3 different tables in this particular questions. The last table, those are the assets and liabilities at the year end. So that means at the year end, at the financial year end, those are the assets and liabilities that is recognized by the joint operation. And remember, this joint operation is owned by both North Limited and South Limited, which means that the year-end allocation is going to be based on this particular table. And there are a number of accounts that you can use the number directly for calculation. And we're going to start with that first. So based on this table, raw material, work in progress, finished goods. Then on the credit side, we got accumulated depreciation, account payable, and accrued expense. Every single one of these accounts, you can use the number on this statement, multiply by that 60% owned by North Limited, and then write down as a journal entry in that year-end allocation. We're going to do that first, and then all the other accounts, we're going to work on that one by one. So the year-end allocation, I'm going to write down year-end allocation here. So 30th of June 2015. So as I said, I identify a few accounts, and I said that we can use the number on the statement, multiply by the percentage interest, and recognize on the journal. So for example, we got raw materials in JO, and it was 320,000 multiplied by 60%. So for that one, we'll get 192. We're going to do the same calculation for the others. So we got WIP in JO, and it was 250,000 on the statement. 60% of that equals to 150,000. We also got finished goods in JO, So you can either say finished goods or you can say inventory. It doesn't make a difference. So write down finished good here. They got 400,000 on the statement. 60% of that would be 240,000. And on the credit side, we also got accumulated depreciation in JO. We're going to leave some gap there because we know that there might be some other accounts on the debit side. So we're going to write down accumulated depreciation in JO. $300,000, 60%, there will be 180,000. Then we also got account payable in JO. $520,000, 60%, which is 312,000. And finally, we also got accrue expense in JO. It was 200,000, 60%, there will be 120,000. So those are the 6 accounts that are identified on the statement where we can use the number directly. How about the other numbers? We have to work out those one by one. So the next one we want to look at is plant and equipment. So how come we can't use the number directly on there? In this question, we got 2.25 million on the statement. So why can't we use it directly? The reason is because initially, the company, one of the joint operator has already contributed $1.5 million worth of equipment. And that amount, you already recognize that on the initial contribution journal. But right now, we got 2.25 million. That means only the difference there is the additional equipment contributed, additional equipment purchased by the joint operation throughout the year. And only the additional equipment can be recognized on the journal entry. So for that one, you can see that we got an increase of 750,000. So we're going to write down equipment in JO. And it was 2.25 minus 2.25 million minus 1.5 million. And then you need to multiply by 60%. So as a result, the amount that we want to recognize is 450,000. So that will be for the equipment in JO. Okay, after that, we have the cost of goods sold. Okay, cost of goods sold. So as you know that the whole point of owning this joint operation is for the joint operation to create product or inventory and for the joint operator to sell them. Then think about that. In terms of this one, when we look at this particular paragraph, you can see that the amounts of outputs distributed by the joint operation will be shared by the joint operator based on the percentage of ownership, which means that for North Limited, they're going to get 60% of that finished goods. And it also says that they have all been sold by both parties before the end of the year. That means the entire amount of goods distributed to them will become cost of goods sold. So how do we actually calculate the amount? We do that by looking at the first table. You can see that the cost of finished goods in total was $4.8 million. Okay, it was $4.8 million. So this is the amount actually finished by the joint operation. But just because they have finished it, that doesn't mean that they have distributed to the joint operator. We need to compare this $4.8 million to the finished goods of 400,000. Because finished goods are the one that's being kept on the balance sheet. It's being kept in the joint operation. So the difference there would be the amount of goods actually distributed to the joint operator. So we can use this information to prepare this particular entry. So we're going to debit cost of goods sold. And very importantly, don't write down in JO for this one. Because for cost of goods sold, that's based on the individual joint operator. The goods have already been distributed to them. is the joint operator who sold that to the customer, which is why cost of goods sold, there's no in JO there. So for this particular calculation, we have 4.8 million. That's the amount manufactured or made by the joint operation, minus the $400,000 that they kept in the record. The whole amount, 60% of that, will be recognized by North Limited. So as a result, the amount of that is 2.64 million. Okay, so we have recognized a lot of accounts. What else do we need to do? Let's go back to the question. So we have already dealt with plant equipment as well. Pretty much all the accounts we have dealt already. The only exception is cash. Okay, before we look at the cash account, there's one additional thing you need to be careful of. Okay, one additional thing you need to be careful of. If you take a look at the table before that, we have a lot of amount spent by the joint operation. And I want you to compare this table, this particular amount here, with the table before. As you can see that we have a lot of similar accounts there, with one particular exception. There's one account that appear on the receipt and payments table, but not on the initial cost recognized by them. That particular one is administration costs. What does that mean? It means that for this one, $80,000, this is the cost incurred by the joint operation, but they have not included in the costing of production. Which means that this $80,000, you will have to recognize that separately. So as a result, we need to, based on this $80,000, go back to our journal and then debit administrative expense in JO. It was $80,000. Once again, you are going to get 60% of that. So as a result, that's $48,000. That's all the account that you need on the debit side. Finally, as you all know, at the end, we have cash in JO on the credit side in order to balance the journal. But even though you know that you're going to balance the journal, I would strongly recommend you to do the calculation instead of using that as a balancing journal. So going back to, there's a trick that we can actually use. Going back to our own journal, you can actually use that for your calculation. You know that North Limited, initially they recognized cash in JO for $1.8 million. And in December, there's another 1.5 million contributed by them. So that means so far in total, North Limited have recognized $3.3 million of cash in JO. We want to compare this 3.3 million to the number that we have here, 320,000. This 320,000 is the total amount of cash remaining on the balance sheet of the joint operation at the end of the year. And you know that 60% of this amount will be recognized or shared by North Limited. $1.8 million plus $1.5 million. So that's the total amount of cash recognized by them, minus 320,000 and 60% of that. As a result, the change there is going to be $3.108 million. After you do this calculation, once again, you can see that this is a very long journal. It's quite possible that you might miscalculate something or miss something. It's very important that you add up all the debit and add up all the credit to make sure that you can balance the journal. So after you make sure that you can balance the journal, then you can move on to see what else you need to do. And in the joint operation question, in addition to the big year-end allocation journal, there might be a couple of other things that you need to do. One is to deal with depreciation. The other one is about management fees. For this particular question, there's no management fees recognized by the joint operator. So that means that we don't need to deal with that. But we do need to think about depreciation. Do we have any additional journal? And you can take a look at this question. You have already recognized the amount of depreciation, which means that you are not going to recognize more. So there are only two possibilities. Either you do nothing, or you need to reverse some of the depreciation. So which one do we need to do here? The key is to go back to the original table that you create yourself and to see which one is the party who actually contributed the equipment, and do we have any difference in fair value. For this one, as you know, we are looking at North Limited, and they are the one who contribute the equipment. And there is a difference between the fair value and also the carry amount, which means that we are going to need to remove the excess depreciation recognized by the North Limited. But very importantly, you cannot use the number here for calculation. Why is that? Because this amount of accumulated depreciation is based on the entire amount of 2.25 million of equipment recognized by the joint operation, but not entire amount of this is contributed by North. As a result, we are not going to use this number for calculation. We are going to do another calculation. So we want to calculate the excess depreciation. So the excess depreciation, this one is based on the difference in carry amount and fair value. So 1.5 million is the fair value, 1 million is going to be the carry amount, which means that they make a gain of 0.5 million, which you know this already. And out of this gain on sale, you know that 60% is still recognized by North Limited because they own 60% of the interest. So this one is about ownership. And then you know that they recognize 15% of depreciation rate based on the original questions. As a result, based on this calculation, the amount of excess depreciation is $45,000. Okay, that's the amount that we want to reverse in terms of the journal. After that, you know that the entire amount of depreciation, this one is part of the cost of production. As a result, we need to allocate this excess depreciation across different costs on a proportional basis. So we need to create a little table for the working. First of all, we need to write down the balance of WIP, finished good, and cost of goods sold. And that amount is all going to be based on the journal that you create. So we got WIP, finished goods, and also cost of goods sold. Those are the three balances that you want on that particular table. So WIP, we got 150,000, 240,000 for finished goods, and 2.64 million for cost of goods sold. And you should also write down a total as well. So the total for this one is 3.03 million. Okay, after that, we need to use the balances to work out the percentage or a fraction or decimal. It doesn't matter. It's just the amount of allocation. For that one, for example, in terms of WIP, we're going to use 150,000 divided by 3.03 million. So if you do that calculation, you'll find out that WIP will get 4.95% of allocation. Finished goods is going to get 7.92, and then finally cost of goods sold will be 87.13. Just make sure that the total there is going to be 100%. And that makes perfect sense. If you got a higher balance in individual accounts, you are going to get more of the allocation. For this one, majority of them come from cost of goods sold. That's why they're going to get most of the allocation. The final column of this table is allocation. And that allocation is based on the 45,000. So we're going to use 45,000 and multiply by each of the percentage there. So for WIP, we got 2,228. Finished goods, we got 3,564. Finally, majority of them will go to cost of goods sold, and there will be 39,208. In total, we're going to get 45,000. So that's the working that we need. And finally, we are going to put the journals together. So for that one, we are going to reverse accumulated depreciation in jail, 45,000. Remember, this is a reversal. We want to reverse the depreciation. That's why we want to debit accumulated depreciation. And then on the credit side, there will be these three accounts. So we're going to credit WIP in jail, and the amount is going to be there. And then we also got finished goods in jail. And finally, we also got cost of goods sold in jail as well. So that's the one that we want to recognize for that particular journal. So that's the end of the question.